Welcome back to the Empowerment Library. In our last episode, we explored Carol Dweck's mindset, a book that showed us how adopting a growth mindset can unlock our full potential in life. But having the right mindset isn't enough on its own. We also need to make smart financial choices if we want lasting freedom and security. That's why today we're diving into John C. Bogle's classic, The Little Book of Common Sense Investing. In this summary, you'll learn why most people lose money in the stock market, the hidden enemies of wealth like costs and taxes, why picking the next hot stock or fund rarely works, and how a simple, low-cost, long-term strategy, index investing, can help you steadily build real wealth over time. By the end, you'll see why simplicity beats complexity, and how patience and discipline are the ultimate keys to financial success. So, let's get started.
Part 1. The Foundation of Investing. Every great journey begins with a strong foundation, and investing is no different. In this part, Bogle sets the stage by showing us why investing is about owning businesses, not chasing market hype. He emphasizes optimism about long-term business growth and warns against distractions. These early lessons are simple but powerful. They prepare us to see investing through a common-sense lens.
Chapter 1. A Parable. Bogle opens with a simple story comparing investors to casino players. At first, everyone seems to be winning, but as time passes, the casino, representing costs and fees, quietly takes its share. The lesson is clear. In investing, most people lose not because markets fail, but because costs eat away at returns. Just like in the parable, the odds are stacked against those who ignore the silent drain of fees. The takeaway? To win at investing, you must minimize costs and play the long game.
Chapter 2. Rational Exuberance. Unlike the famous phrase irrational exuberance, Bogle argues that optimism in business is actually rational. Over the long run, businesses grow, innovate, and create wealth. The stock market, however, swings wildly in the short term, creating fear and greed. By focusing on the underlying businesses rather than daily price moves, investors can see the bigger picture. Bogle reminds us that investing in businesses means sharing in their long-term success. That's where real wealth is built.
Chapter 3. Cast your lot with business. Bogle stresses that stocks represent ownership in real companies, not just ticker symbols. When you buy shares, you're investing in the productivity, innovation, and profits of businesses. Speculators, however, trade pieces of paper hoping for quick gains. The difference between the two approaches is the difference between building wealth steadily and gambling. By casting your lot with business, you align yourself with long-term growth. The key is patience, discipline, and faith in enterprise.
Part 2. Why most investors lose. Even though investing should be a winner's game, most people end up losing. Why? Because emotions, costs, and bad strategies quietly sabotage their results. In this part, Bogle exposes the illusions that trick investors into chasing quick profits. He also shows how taxes and timing can quietly drain wealth. These chapters highlight the common traps that turn smart intentions into financial mistakes.
Chapter 4. How most investors turn a winner's game into a loser's game. The stock market, over time, generates positive returns for those who stay invested. Yet, most investors underperform the market. Why? They trade too often, chase hot trends, and pay high fees. Each of these habits erodes returns bit by bit. Bogle explains that the game is designed for long-term winners, but impatience and greed turn it into a losing game. The lesson: stop trying to outsmart the market and simply stay in it.
Chapter 5. The Grand Illusion. Here, Bogle dismantles one of Wall Street's biggest myths, that professional managers can consistently beat the market. While a few succeed temporarily, the vast majority fail once costs and risks are considered. Investors often fall for flashy marketing and promises of expert stock picking. But Bogle calls this the grand illusion. The system appears to create value, but in reality, it drains investor returns. The truth is sobering. Simplicity outperforms illusion.
Chapter 6. Taxes are costs too. Most investors forget that taxes are just another cost, just like management fees. When you buy and sell frequently, the government takes its cut, reducing your net gains. Bogle stresses that minimizing turnover and holding investments long-term lowers tax burdens dramatically. This is one more reason index funds are powerful. They are naturally tax efficient. Ignoring taxes is like ignoring a slow leak in your boat. It will eventually sink your returns.
Chapter 7. When the good times no longer roll. Markets don't move in straight lines. Periods of boom are often followed by bust. Many investors get caught up in euphoria when times are good, only to panic and sell when the market falls. Bogle reminds us that timing the market is nearly impossible. Those who try usually miss the best recovery days and end up worse off. The only solution is to accept volatility as part of the journey and stay the course.
Part 3. The futility of fund picking. One of the biggest temptations in investing is believing you can pick the next big winner. Whether it's choosing a star mutual fund or listening to an expert's tip, the allure of beating the market is strong. But Bogle shows us why this pursuit almost always ends in disappointment. Past performance doesn't guarantee future success, and even professionals struggle to stay ahead. In this part, we learn why chasing winners is a trap, and why true success lies elsewhere.
Chapter 8. Selecting long-term winners. Investors often dream of finding the perfect mutual fund that consistently outperforms. But Bogle makes it clear, almost no one can predict which funds will succeed over decades. Even when a fund does well for a time, competition and costs usually drag it back to average, or worse. Trying to pick long-term winners is like betting on horses without knowing the race outcome. The odds are stacked against you, and patience in the market is safer than chasing the impossible.
Chapter 9. Yesterday's winners, tomorrow's losers. One of the greatest mistakes investors make is assuming that past success will continue into the future. Bogle demonstrates that top-performing funds one year often underperform in the years that follow. Chasing yesterday's winners means you're likely buying high and selling low. Instead of following hype, investors should stick to broad, low-cost index funds that capture the whole market. History teaches us, winners rotate, but the market's average endures.
Chapter 10. Seeking advice to select funds? Many people turn to advisors or financial gurus hoping they can identify superior funds. But Bogle warns that most advisors are influenced by sales commissions, not your best interests. Even well-meaning experts are usually guessing in the dark, since no one can reliably beat the market. Paying extra for such advice often leads to worse outcomes, not better. The reality? The simplest advice, buy, hold, and minimize costs, is the best advice of all.
Part 4. The case for indexing. After exposing the traps of speculation and fund picking, Bogle now presents the solution, indexing. Index funds are simple, low-cost, and broadly diversified, making them the smartest way for most investors to succeed. Instead of trying to beat the market, they allow you to own the market. This part explains why indexing works across stocks and bonds, and why simplicity always outperforms complexity. Here, Bogle shows us the common-sense path to wealth.
Chapter 11. Focus on the lowest-cost funds. Costs matter more than most investors realize. Every percentage point you lose to fees is a percentage point gone from your returns, forever. Bogle emphasizes that keeping costs as low as possible is the single biggest advantage investors can control. Index funds shine here, often charging a fraction of the fees of actively managed funds. Over decades, the savings compound into massive differences in wealth. The golden rule: in investing, you get what you don't pay for.
Chapter 12. Profit from the majesty of simplicity. Wall Street thrives on making investing look complicated, but Bogle argues the opposite. The simplest strategies, like buying and holding a broad market index fund, are the most effective. Complexity invites mistakes, confusion, and higher costs. Simplicity, on the other hand, offers clarity, discipline, and consistency. By cutting out unnecessary layers, investors can capture the true growth of the market. The majesty of simplicity lies in its quiet, compounding power.
Chapter 13. Bond Funds. Keep it simple. Stocks may deliver higher returns over time, but bonds play a vital role in stability. Bogle recommends the same philosophy for bonds. Keep it simple with low-cost, diversified bond index funds. Active bond managers, like stock managers, rarely add lasting value after costs. For most investors, a balanced mix of stock and bond index funds provides both growth and safety. Bonds may not be exciting, but their steady income helps balance the ride.
Chapter 14. The Index Fund Solution. This chapter ties it all together. Bogle presents indexing as the ultimate solution for individual investors who want to build wealth without gambling. Index funds eliminate the need to pick stocks, time the market, or chase winners. They guarantee average market returns before costs and outperform the vast majority of alternatives after costs. The message is clear. Common sense says to own the market, keep costs low, and let compounding do the work.
Part 5. The Hidden Enemies of Returns. Even with the best plan, investors face hidden enemies that quietly chip away at their wealth. These enemies are not dramatic crashes or obvious mistakes, but slow, silent forces like taxes, complexity, and human behavior. Bogle warns that ignoring them can undo years of disciplined investing. In this part, he reveals how to fight back with patience, simplicity, and self-control. Mastering these lessons is just as important as choosing the right investments.
15. Taxes. Where returns go to die. Taxes are often overlooked, but they can take a huge bite out of long-term gains. Frequent trading triggers capital gains taxes, which steadily erode wealth. Bogle points out that index funds are naturally tax-efficient since they trade very little. Holding investments for the long term means you delay or reduce the tax burden, letting compounding work in your favor. Smart investors treat taxes like any other cost, something to minimize wherever possible.
Chapter 16. Profit from the Majesty of Simplicity, Expanded. Bogle revisits his favorite theme, simplicity. Here, he goes deeper, showing how too many investors complicate their portfolios with dozens of funds, exotic strategies, or constant changes. This complexity rarely adds value. It only increases costs and confusion. The expanded message is clear. A simple portfolio of a few low-cost index funds is enough to build lasting wealth. Complexity is the enemy. Simplicity is your ally.
Chapter 17. Behavioral Tricks. Stay the course. The greatest enemy of returns is often the investor's own behavior. Fear during downturns and greed during booms cause people to buy high and sell low. Bogle stresses the importance of discipline, sticking to your plan no matter what the market does. Stay the course is his timeless mantra. Those who panic or chase fads almost always lose. True success comes from patience, self-control, and trust in the long-term power of markets.
Part 6. The Universal Truths of Investing. In the final part of the book, Bogle strips investing down to timeless truths. He shows that beyond all the noise, investing is ultimately about arithmetic, discipline, and patience. The math never lies. Costs reduce returns, and time rewards those who stay invested. He also explores what happens when more people adopt indexing, and leaves us with his final wisdom. These closing chapters are simple but powerful reminders of why common sense always wins.
Chapter 18. The Relentless Rules of Humble Arithmetic. Investing success isn't about brilliance or secrets. It's about basic math. Bogle explains that the market's total return is available to all investors, but once you subtract costs, most people get less. Active managers may shuffle money around, but collectively they cannot beat the market because they are the market. Arithmetic is relentless. The more you pay in fees, the less you keep. The humble truth is that indexing, with its near-zero costs, guarantees better results for the majority.
Chapter 19. What happens when the crowd realizes the truth? Some critics argue that if everyone indexed, the system wouldn't work. Bogle counters that this will never happen. There will always be speculators chasing short-term gains. Even if indexing grows, markets will still function because trading never stops. In fact, wider adoption of indexing benefits everyone by reducing costs and stabilizing returns. The truth is that common sense investing doesn't break markets, it saves investors from breaking themselves.
Chapter 20. The Last Word. Bogle closes with a simple but profound message. Stay patient, stay disciplined, and keep things simple. Investing is not about excitement or quick wins. It's about building wealth steadily over a lifetime. Index funds offer a straightforward, low-cost way to do exactly that. Ignore the noise, resist the temptations, and remember the power of compounding. His final word is clear. Common sense investing works, but only if you stick with it through every market storm.
Conclusion. That brings us to the end of John C. Bogle's The Little Book of Common Sense Investing. Throughout this book, we've seen how most investors lose not because the market fails, but because of hidden enemies like high costs, taxes, emotional mistakes, and the illusion of fun picking. Bogle's message is simple yet powerful. Own the market through low-cost index funds, keep your strategy simple, and most importantly, stay the course. True wealth doesn't come from chasing fads or timing the market. It comes from patience, discipline, and trusting the process. If you apply these timeless principles, you don't just invest smarter, you invest with peace of mind. So remember, common sense investing isn't flashy, but it works. And as Bogle would say, don't look for the needle in the haystack. Just buy the haystack.
As we explored John C. Bogle's timeless guide, The Little Book of Common Sense Investing, I hope these lessons inspire you to simplify your approach, cut through the noise, and build lasting financial freedom with confidence. In our next episode, we'll be diving into Make Time by Jake Knapp and John Zeratsky, a practical book that shows you how to take control of your day, focus on what truly matters, and create more time for the things you love. So if you're ready to master not just your money but also your time, you won't want to miss it. See you there, and thank you for being part of the Empowerment Library.